The best deal in a bad market is still a bad investment. I've watched investors buy properties at great prices in markets with declining populations, shrinking employment bases, and falling rents, and struggle to find tenants, exit the investment, or generate any meaningful appreciation. The deal looked great on paper. The market made it irrelevant. Market selection is the foundation of every successful real estate investing strategy. In this video, I'm going to give you the exact 5-indicator framework I use to evaluate any market. The same framework I have applied across 400 transactions over 19 years. My name is Rick Puglisi. Let's get into it. Indicator 1. Population growth. People drive real estate demand. More people need more housing. Fewer people means more competition for tenants and buyers. Look for markets with consistent population growth over the last 5 to 10 years. U.S. Census data and platforms like Data USA provide population trend data at the city and county level. The fastest growing markets in the United States over the last decade have predominantly been in the Sun Belt: Florida, Texas, Arizona, Tennessee, North Carolina. These markets have seen strong rental demand and appreciation as a result of population inflows. Markets with flat or declining populations require more careful analysis. They can still offer investing opportunities, particularly in distressed property strategies, but the natural tailwinds that make investing easier are absent. Indicator 2. Employment and economic diversity. Employment drives population growth and tenant stability. Markets with strong, diverse employment bases attract residents and keep them there. Look for markets with multiple large employers across different industries. A market dominated by a single employer is vulnerable. If that employer downsizes or that industry contracts, the ripple effect on real estate can be severe. Look for markets attracting new employers in technology, healthcare, and distribution. Unemployment rate, wage growth, and job creation data are available from the Bureau of Labor Statistics at the local level. Indicator 3. Supply and demand. The fundamental driver of real estate prices and rents is supply relative to demand. When demand exceeds supply, prices and rents rise. When supply exceeds demand, they fall. Vacancy rate is the key metric. A healthy rental market has a vacancy rate below 5%. Above 8% suggests an oversupply or weak demand. New construction permits tell you what's coming. Days on market for rental listings tells you how quickly units are being absorbed. Fast absorption, under 30 days, indicates strong demand. Indicator 4. Price to rent ratio. Divide the median home price by the annual median rent. A ratio below 15 generally favors buying. Properties cash flow well relative to their price. A ratio above 20 generally favors renting. Properties are expensive relative to rents. The highest cash flow markets, where the buy and hold investing is most profitable, tend to be in the mid-tier cities in the Midwest and South, where prices are moderate relative to rents. The lowest cash flow markets tend to be the high-cost coastal cities, where appreciation has outpaced rent growth. Indicator 5. Landlord-friendly laws. State and local landlord-tenant laws significantly vary and affect the economies of rental investing. In landlord-friendly states, where eviction processes are faster and tenant protections are less restrictive, the risk profile of rental investing is lower. Florida, Texas, Georgia, and most southeastern states are generally considered landlord-friendly. California, New York, and several northeastern states have strong tenant protections that extend eviction timelines and restrict rent increases. This does not mean you cannot invest in tenant-friendly states, but factor the regulatory environment into your risk assessment and cash flow projections. How to research a market. Specific resources I use regularly: U.S. Census Bureau, population data, demographic trends, income levels at the zip code level, Bureau of Labor Statistics, employment data, unemployment rates, wage trends by metro area, Zillow and Realtor.com research sections, median prices, days on market, inventory levels, rent trends. Local real estate investor associations, the most current on-the-ground market intelligence available. Investors who are actively transacting in a market know things that no data source captures. When I enter a new market, I spend time in the local REIA before I spend $1 on a property. The knowledge I gain from active local investors is worth more than any amount of online research. The market you invest in is as important as the deal you buy. Run every market you consider through these 5 indicators before you spend $1 analyzing a specific deal. If the market fails the test, move on. The right deal in the wrong market is still the wrong investment. Market analysis is covered in Mastering the Real Estate Investing Program. Start with the free 5-day challenge. Click the link in the description. 0 cost. The real Rick is a great investor. The AI Rick is a great investor who remembered to iron his shirt. Hit subscribe for weekly content. Drop a comment. What market are you currently considering, and what is drawing you there? I read every comment. I'm Rick Puglisi. Pick the right market. Everything else gets easier.